What is up, world? It's your boy Ton, and you are listening to the Wonton Wealth Podcast. Here, I'm going to unravel anything and everything commercial real estate related. And more importantly, we're going to add abundant value. So if you're ready, buckle up your eardrums. Boy, Cincinnati is clocking in at over 90 degrees today. It is hotter than hell. And on top of that, my thermostat decided to shit out on me this morning, so we got to figure that out. So my house is hot as shit, but I'm still out here recording videos for you guys. So let's get to it. Today, we are going to be talking about loans and who is typically on the hook for those loans when you take out a loan. And like I've mentioned before, in the CRE realm, we're going to have recourse loans. And lenders are going to want someone on the hook for the loan in case of a default. Now, the person that's going to be on the hook is typically the guarantor. Now, sometimes when you're taking out a loan, you're going to have an individual on the loan, or sometimes you're going to have the LLC that owns the property. So in those cases, if you own the LLC, you're going to be the guarantor on the loan. However, that's not always going to be the case, because if the bank doesn't like your financials or they deem that you're not worthy or credit worthy, sometimes you're going to have someone else be the guarantor on your loan. Now, whether it's you or someone else that's going to be the guarantor on the loan, you're going to have to know a couple things. Firstly, you're going to have to understand the loan terms. That means you got to know what the interest rates are, you got to know the repayment schedule, and the penalties if you have late payments. You also have to figure out the borrower's repayment ability. Now, once again, it could be yours or the guarantor that you bring on board. You have to figure out if they have the financial capacity in order to repay the loan, because the guarantor is going to be the one that's responsible in case of a default. Now, you also have to evaluate your financial situation. You got to consider the impact of taking out this loan upon your finances, and you got to ensure that you can make the loan payments if necessary. You also have to know the legal implications. So guarantor agreements are typically legally binding. If you don't know what the doc means or what you're signing with the bank, make sure you have it reviewed by an attorney. And lastly, you always want to maintain those relationships with either with the bank or the guarantor, and communication is key. You don't just want to sign a loan for anybody, nor does a different guarantor just want to sign a loan for you without knowing you. Because at the end of the day, if they end up having to pay for those payments, they're not going to be very happy. And plus, for some reason they don't make those payments, you'll be in the shitter. So if you're looking for a guarantor, know that every party involved has to understand the legal implications and what those documents are stating. Once again, get an attorney, because they're going to spell out everything for you. Now, if you don't meet the lender's requirements, you're going to need a partner anyways. So that partner is going to have to be a high net worth individual and or an experienced investor in order to co-guarantee the loan with you. But here's a caveat. If the high net worth individual lacks experience, you're kind of in the shitter, and you're going to have to find a seasoned investor with a successful track record. Banks love to see that. As a guarantor, you're also going to have to meet some requirements. Usually the guarantor has to be a U.S. citizen. They're going to have a net worth that's equal to or greater than the mortgage amount. Their liquidity also has to equal about 9 months or so of the debt service, or 10% of the loan amount. And lastly, they're going to have to be creditworthy. Their FICO score is going to have to be at least 650 or better. As with anything, there are risks. And you're probably thinking, why the hell would I sign to be a guarantor for anyone else? Or why would anyone else be a guarantor for me? Now, that's where negotiations come into play. And that's where you have to figure out a way to offer a compelling compensation package to offset those potential risks that the guarantor is signing on. So compensation structures are going to vary based on the loan type. And the two most common ways that I've seen it is, one, a straight compensation for being the guarantor, or two, an equity stake. So if they're directly getting compensated for being the guarantor, they can make a fee for being the guarantor. And this fee can range from 3% to 5% of the principal balance. So, for example, if you had a $1 million loan, you're looking at roughly $30,000 to $50,000 as a fee for the guarantor. Now, alternatively, if you're looking at the equity stake route, this means that you can offer them a percentage of ownership in the investment. So that could be part of the GP side, and that percentage will vary based on your negotiations. And I've seen them in the low digits, anywhere from 1% to maybe even 10%, depending on the deal. Sometimes I've seen them even as high as 30%. And once again, this kind of depends on your negotiation and the specific circumstances of that deal. Now, you can also get creative and offer both. Another term I want you guys to get familiar with is key principles, or KP. Becoming a key principal or needing a key principal in a deal can be a challenge, very similar to having a guarantor on the deal. Now, key principals are the individuals or partners in your deal who apply for and ultimately assumes the responsibility of the loan. The lender is going to closely examine their personal credit, their net worth, their liquidity, and their experience in order to evaluate whether or not they're eligible as a borrower. So once again, there's a lot of recourse loans in the commercial realm that we're dealing with. So the key principals are going to be the ones signing the promissory note, the deed of trust, and the personal guarantee. And lenders typically like KPs with substantial financial strength and a track record of relevant experience. It can't be, if you're buying a strip mall, you can't have a KP that's been in the game with multifamily or hospitality. So make sure you choose your KPs adequately. And in a lot of cases, sponsors or investors who are contributing a large portion of the down payment are going to be required to assume the key principal roles. And typically that number is around 20%. Now, if you are the sponsor and you lack the experience and the financial strength to qualify for a mortgage, don't get discouraged. You just need to bring on an investor or a KP that has commercial property ownership and experience and hopefully deep pockets in order to be a KP on the loan with you. Once again, you're going to be looking for someone who's a high net worth individual, and they could potentially be looking to diversify and to invest some of their funds in real estate with you. But they might not want the responsibility of being the sponsor or the managing partner, because likely you'd want to keep that control for yourself. However, once again, there are different situations out there, and you're going to have to navigate those waters accordingly. And there you have it. There's a lot of nuances when it comes to being a guarantor on a loan, so make sure you know all of the stipulations. And that's a wrap. If you've made it this far, that means you've listened to the entire episode, so thank you. I hope you enjoyed it, and if you did, please leave a review on Spotify, Apple Podcasts, or wherever you're listening from. And if you've learned something or found it useful, share it with one of your homies. And if you want to get in touch with me, I'm pretty active on IG. My handle is pro_TANH. Reach out, let me know what you liked, what you didn't like, or what you want to hear about in the future. I'm here to tailor this to you. Until next time.